Why is this not? Oh, there we go. What is wrong? Good morning. Today is March 26th, Sunday, March 20th, and thank you for joining me. If you're on the Google conference call or watching this on YouTube now or later, appreciate you taking the time out of your day. Um, Today, I want to discuss um, really two broad topics. Um, First, I'd like to talk a little bit about the macroeconomic outlook. Um, and when I say that, I really mean the broader housing market, not so much the entire actual economy, but more the bigger picture view of the housing market. And secondly, I'd like to talk a little bit more, go over, do a little refresher on uh, doing market research and understanding your market. Um, so first, of course, we have the housing market, um, and things have been. Oh, I hope that wasn't affecting things. There was a YouTube video playing in the background. Anyways, we have the housing market, and things have been very, I guess, volatile over the last, what do we want to say, 2 3 years. Obviously, we saw a big boom in housing prices. Everything shot up, and then COVID and other economic factors. Or I shouldn't say COVID, but the COVID response and other economic factors. We saw prices crash from their recent highs. Um, and then we've seen them oscillate a little bit with some ups and downs. Everybody is, of course, concerned about interest rates and what effects those will have on prices, property values, payments, and et cetera, et cetera. And of course, this concern is compounded by anxiety from news in the banking sector, which of course banks issue mortgages. So the banking sector is very important to real estate and real estate investors. The banking sector having a series of banks having bank runs or having um, bank defaults and failing, and in some cases requiring a bailout. Obviously, a few weeks ago, there was Silicon Valley Bank and a string of American banks. After that, there was Credit Suisse, which is one of the larger banks in the world. And this week, it sounds like Deutsche Bank, which is the largest bank in Germany. And I think the next largest bank after or before TD in the world, so quite a large bank, um, appears to be insolvent or on the verge of insolvency and in need of possibly a bailout or something, or otherwise a buyout, or perhaps just failure. We'll have to see. So these factors are going to interplay, right? And they're going to affect the housing market because the majority of real estate is bought with credit, not with cash. Um, Interest rates and the availability of funds for borrowing is going to impact the demand on real estate. And that is in turn going to affect prices. Now, there's a problem in the Canadian real estate market where some of the banks have created a lending product known as a fixed payment variable rate mortgage, and this mortgage product allows you to lock in your payments for your 5-year term, And so for the entire 5 years, you're going to make the same payment. But the interest rate is variable. So as interest rates go up or down, you lose or gain money, I guess, essentially, on your loan, right? And so these were very attractive mortgage products, and a lot of Canadian mortgage holders bought into them. They represent about 20% of CIBC, TD, and BMO's mortgages, outstanding mortgages, and so they're quite a significant proportion of the mix. And what happens is, or what is happening, is that those 20% are in what is called negative amortization, which means that as the interest rate has climbed, right, the deficit between how much they're paying and how much they need to pay to keep up with their amortization schedule is growing, right? So if they're making a $3,500 a month payment, but the interest rate has risen 3%, and now they actually need to make a $4,500 a month payment, then every month they're falling behind by $1,000, right? And at the end of the 5-year term, or when they sell the house, right, whenever the mortgage is terminated, they owe that difference. You can't hear me. Uh-oh. Have I been talking to no one this whole time? You are hearing me. Yes. Okay. Huh. Let's see. What happens if I leave? General caption. Remove you from a call after a few minutes if no one else joins. Send analytics. That's fine. That's fine. Okay. If I leave the call and then I rejoin, can you hear me? You can hear me there. That's hearing me for sure. Okay. So now try. Can you hear me now? I hope YouTube's probably catching this, and oh, this is terrible, but can you hear me now? Why does it look like I can hear you? Should I be able to hear you? Oh, I can hear you. Yeah. Can you hear me?
Yeah.
So it's clear now. Okay. I don't know what was going on there, but
It said like it was running there and it's like okay.
but no. Okay, thank you. All right. Let's see. Where was I? So we have these fixed payment variable rate mortgages. You have a $3,500 payment. Interest rates rise 3%. Now you have a $4,500 payment, so you're short $1,000. You owe that difference at the end of the mortgage, whether you sell it or whether you come to your 5-year term, right? So this is the situation that these people are in, and that's a crappy situation. We do know, really, since 2021 or so, interest rates have risen, and they've risen by about 4 or 5%, which actually means payments should have gone up by as much as $2,000 or so, depending, of course, on how much they've borrowed. But I'm thinking here of approaching $1 million mortgage, since that's around the prices of the homes. And of course, at the peak of the market, that was about the average price of a home. I think it was $1 million or 1.1, something like that. I mean, depends on the area. I'm not talking Canada wide, but in the GTA, was right around that area. And so people were buying houses. getting a 1.9% interest rate or a 2% interest rate, 2.5% interest rate, something like that, with a fixed payment variable rate mortgage, and they bought $1 million house, and now 2 years later, prices crash, so that $1 million house is not worth $1 million anymore. Maybe it's worth 900, maybe it's worth 850, maybe 800, somewhere in that range. That means their $200,000 down payment is wiped out. Boom, they have no equity in the property, and they're losing $1,000 of equity every month. And now, if something happens where they're unable to continue paying that mortgage and they need to sell the house, well, there's nothing in it for them to sell, right? They can sell it, of course, they'll end up in debt to the bank. They're really in no hurry to do so. And so they may default on the home. And if they default on the home, then the bank writes off the mortgage. And if the bank writes off the mortgage, that's a loss for the bank. And of course, if the bank takes enough losses, either we have to bail them out or they have to fire people, or both, right? So these are all things that then affect the broader economy, because of course, the people who get laid off at the bank are also probably people who hold mortgages and have have bills to pay, right? So now they can't pay those bills, and the cycle continues. And you would hope that if they work at the bank, they didn't take this product because they have a savvy understanding. But the reality is that a lot of times bankers, at least at the lower level, right? I'm not talking about the guys in the C-suite, are not that sophisticated, right? And so they follow the directives of the bank, but they're not much more sophisticated about their finances than you or I. And actually, in a lot of cases, if you're interested in investing in real estate and securities and things of this nature, then you're probably more sophisticated than your average bank staff is. So you can almost guarantee some of them took these types of mortgages and they're in this situation, although hopefully not most of them. But either way, my point is there's a knock-on effect, right? Those people can't pay, they lose their job, which leads to more people who can't pay, who lose their job, which leads to more people who can't pay, who lose their job, right? And obviously, if you had a job and then you lost it, and now you've got no money because you put your savings into your home, and obviously you don't want to lose your home, so you're spending your savings to pay off the mortgage if you can, but now you've run out of that, and now your only option is to sell the house because you have no income, but that just puts you further in debt. Then obviously you're no longer a consumer, right? You're not going out and buying goods. You're not going out to, the mall or to nightclubs or strip clubs or bars or any of the other things that move the economy, right? You're not about to buy a car. You're probably not about to start a business. All of those things which are good for the economy, you're now not in a position to do and won't be for a while because you've got to work your way out of this debt, right? So that's also a knock on, because those cars that don't get bought and the strip club lap dances that don't get danced and the drinks that don't get drunk at the bar and et cetera, those are other people's jobs, right? And so this is how we get what you call a recession, how you trigger a recession, right? That's exactly how it happens. You have one domino knocks over another domino, and before long, you have a whole bunch of dominoes laying on the floor, right? And that's more or less a recession. There's a domino effect of basically, what's the best analogy would be a margin call. If you're familiar with a margin call from trading stocks and securities, right? If you buy a stock, right, with leverage, right? So let's say you have 100% leverage. So you've got double the money that you have. So you've borrowed half the money for the investment, and you have a margin call at 50%, right? So that means you owe back all the money when you owe back. Sorry. How do we hold it? Sorry. How is this phrased? You owe them all of the money if the price drops 50%. So in other words, you have $2,000, right? Of which you have $1,000 and you borrowed $1,000. So you owe them $1,000 and $1,000 is yours. When that $2,000 has declined by 50%, either you have to give them more money or you're going to get margin called, which means they take your $1,000 and close the trade. So they keep their money and you get screwed. That's a margin call. So you're up against it. There's no value left in the trade for you, and your partner in the trade is protecting themselves and taking their money out, and you don't have an option. You get forced into a loss position. That's what a margin call is, right? And so the same thing happens in the greater economy, except it's not a margin call, but it's just people living disordered or disorganized lives, right? And sometimes it's not even that. I mean, sometimes life is just hard, right? But somebody's living so close to the line that something happens, maybe they lose their job, unexpected expense, something or other, and it functions as a margin call. It's the straw that breaks the camel's back. They can no longer afford to maintain their other debts and responsibilities, and so the house of cards comes crumbling down. And our entire economy does the same thing from time to time, and we call these recessions. That's more or less what it is. And with the mortgages set up the way that they are, there's a vulnerability in those banks that should unemployment begin to rise, that might start the domino effect, because those people will lose their jobs. They'll get margin called on their homes. There won't be any equity there. They'll literally walk away, and now now the bank will be stuck with a whole bunch of properties that they have to foreclose on and sell into the market. And it'll be a down market for exactly the same reason that they have the houses foreclosed on in the first place. There won't be a market to buy them because the houses are essentially overvalued, and so they're getting margin called, right? And so now the bank is going to try and sell possibly thousands of houses all at the same time, which will be met with lackluster demand, and so prices will fall. And there will be a short period where we see relatively low prices. Now, in the housing cycle, right, we have expansion, right? Peak. So hold on. Expansion goes like this, right? Rents are rising faster than housing costs. That's expansion. And so because rents are rising faster than housing costs, or property values are rising faster than building costs, that is a signal, right, for investors to build more houses, to build more rental units, to create more supply, right? So expansion leads us to a peak, right, where now it's really over expansion, where we've been chasing that signal, and now we've built more houses than we need. We've got more rental units than we need. And so the prices start falling, right? And now we go through retraction, where those prices are falling. And now those of us who've overextended ourselves get squeezed, right? Because, I built a house that I need to sell for $1 million in order to make money on, thinking that there was a market for houses at $1 million, but there's too many houses, and now it'll only sell for 900, and I'm going to lose $100,000, and maybe my construction company or development company is going to go out of business, right? Same thing. Maybe I bought a house that I need to rent for $3,500, thinking that was the rent I could get for it, but actually the market can only bear a $3,000 a month rent. And so I'm losing $500 a month, $6,000 a year, and let's just assume there's no equity growth or anything like that. So this is a losing proposition for me. Doesn't make sense. So I'm not going to want to hold that property, and it's not going to be as valuable. Its price has to fall, and the rental rate has to fall, right? So that's the retraction, right? Now, things are being pulled back, right? And then we get to the bottom, or the trough. I guess you don't call it a trough. That's more of a business cycle thing. But the bottom, right? And so the bottom is now nobody's building houses, and nobody is buying rentals because they were overbought. So now the price resets and it falls. So now the prices have dropped on these things, and we get to a bottom where nobody wants them, and the prices keep going down. And then that leads into expansion, where because the price is falling, now people are jumping in and they're buying the oversupply of houses, or they're buying the oversupply of rentals. And now, because they bought them for a cheaper price, they can afford to rent at the current market price for the $3,000, or they can afford to sell for the $1 million. Well, it won't be $1 million; it'll be 900,000. They bought for $850, something like that, right? And at some point, they've bought up all of those cheap houses that were over allocated before, right? And then the process starts again. We go back into expansion because now rents rise again and blah, blah, blah. Now, obviously, we have a market, right, in Canada, really, but certainly in Ontario, where prices have far outpaced rents, right? And it is not the economic logic of some of these rental properties is really not there. If it's really not there in these larger cities, if you're doing everything correctly, which is why we do see a lot of illegal rentals, right? Unregistered, not necessarily the code, basements being rented out, that sort of thing. So in theory, right, prices need to return to a level that justifies the rents that you pay for the properties. And even in properties where there's no renting going on, while there may be a premium to be away from renters, in general, those houses should also justify their price by their rent, roughly speaking. Right? And that just makes sense. Think about it, right? If you're a person, do you rent a property or do you buy a house, right? Owning a house is going to be more expensive than renting a property, but you get the equity and the control and stuff, right? But in general, you're going to compare the cost of owning that house to the cost of renting, and you're going to do a judgment. If it was $500 to rent a nice place, who would want to spend $3,500 a month on buying a house? They wouldn't, right? So the justification for these are substitution goods, right? You can rent or you can own. Either way, you have a place to live, right? So they can be substituted for each other. So their prices in relation to each other, or at least it should be in a properly working economy. They should always be in relation to each other, right? Even for people who are not thinking about ever renting their home or who aren't investors, they should still be doing the math. Hey, I could rent for this much. I could buy for this much. What am I going to do? And most people do that math, even if they're not really particularly conscious of it, right? And certainly there is a culture here that values home ownership, or at least there certainly used to be. I don't know if that's still there. So that there's a premium placed on owning a home, and people are willing to pay more for that. But that calculus is done, right? It's the same thing. If you're going to buy a condo, how much does it cost you to buy a condo versus rent somewhere? If the cost is about the same, then most people would prefer to buy and own. But if there's a big discount to be had in renting, people will do that and they'll spend their money elsewhere, right? They can go on more vacations, they can save more money, they can invest. There's lots of things you can do when you're renting because you haven't put all that money up into the property. You can't do when you buy the property. And in a lot of cases, buying the property is not necessarily a very good, like if you think about it, if you're going to buy $1 million home, that's a $200,000 down payment plus whatever, and then you're going to live in it, so you're going to eat all those expenses, negative $3,500, $4,500, maybe $5,500 a month in expenses, right? So you're going to eat that, call that $60,000 or $70,000 a year, right? That's all going to come out of your pocket, right? You could rent a place for, I don't know, $2,500. That's almost a $3,000 a month saving. That's $36,000 a year, right? Plus, you keep the $200,000 that was in your pocket. So at the end of the first year, you've got $236,000 that you can invest. Average stock market return, if you just buy VTI or one of the other indexes, S&P 500, something like that, is approximately 7% per year, right? So we're talking about an extra $14,000 to $16,000 on top of the 36. So that 36 becomes 48, right? And now you're talking about making an extra $48,000 a year by not buying that house, right? Which actually, when you do the math, that extra $48,000 a year, you're almost there to having another house, right? And that's doing the stock market. If you took that same $200,000 and you do buy a house, but it's a rental property, and you can get maybe a 12% return, then you could be making, $70,000 a year or more. And if you're making $70-something thousand a year, that's actually enough to pay another mortgage, right? I mean, you're going to have to get the down payment first. So you got to wait the first few years or figure out a way to refinance or something like that. But that's enough to pay another mortgage, right? And get another house to do the same thing and on and on. So the comparison, that level of analysis and comparison is not done by your average home buyer, obviously, but the comparison is done in a very shallow way that, hey, I could do this one thing, but instead I'm going to do another thing, right? I hear, hang on one second. There, I don't know if that was making noise, but it should be quiet now. Right, that's the comparison that should be being made, and so by understanding market rents, we have an understanding of where prices should be. Now, I expect that in a market like Toronto, there are a lot of factors affecting price other than just the rental value of these properties. And while that might be the underlying economic valuation, there's a whole bunch of sentimental and other factors that go into the equation. So I don't expect that if we see a correction, right, if we're going through that retraction cycle and we're going to get to the bottom and have our correction, I don't expect that prices will fall in line with rental rates. I think that'd be too optimistic. I think they'll try and get close, right? We've certainly seen there's been a lot of upward pressure on rents, right? They've been up an average of like 27 or 30% this year over the last 12 months or so. So definitely rents are rising to try to meet the upward prices. And now we've seen prices fall a little bit. And so they are moving towards each other, but just the way that the GTA is, unless something changes with the fundamentals, I think there's too much demand. There's too much demand or there's too low of a supply, however you want to look at it, for prices to actually get in line because the market is distorted, right? And so that difference is there and it's big, right? One of the reasons the market is distorted is because the government is very involved in the construction process, right? You've got obviously permitting, and you've got environmental inspection, and you've got engineering, geological surveys, and water, and et cetera, et cetera. So you've got all of these requirements that you need to fulfill for the government, and permits and plans, and blah, 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 blah. And I'm not saying these things are bad or anything. Some of them are good, but a lot of it is of questionable value. And so it adds hundreds of thousands of dollars of expense, time, et cetera, into the cost of producing a housing product, right? And so that added expense, that added cost is going to make it so that it's that economic calculus, right, that the builder is doing. Is this profitable? Well, all that extra cost that the government adds into the process means that he does not find it valuable to deliver his good or service until well beyond the point at which the market is actually demanding it. Right. So where supply and demand should rest is being pushed, right, by the chunk of extra money that the government takes from that builder. Right. And so that pushes out the point at which supply and demand are going to meet. And so that causes a higher price. Right. Because I'm not willing to supply at the point where supply and demand should naturally meet, because I actually have to take that loss into account, and it pushes up my threshold for action, right? And so in Ontario, this is a huge problem because it's on the order of hundreds of thousands, like probably about 50% of the cost of a new home is government and regulatory fees, taxes, et cetera, right? So that means that essentially we could have 50 how do I put it? We could be 50% closer to satisfying demand if the government got out of the way of those expenses, right? And obviously, the way our society operates, there's not going to be a Wild West where people just build homes with no oversight. There's going to be a permitting process, and there are going to be certain regulatory hoops that builders are going to have to jump through. But certainly, just as an aside, in Ontario, we could reduce those hurdles and those expenses and make it much, much more economically attractive for developers to develop, and therefore satisfy our housing requirements and make housing much more affordable and economical. But we don't do that because, well, in my estimation, look, there's a lot of people benefiting from the lack of housing supply, right? There's people getting rich for holding property and doing nothing else. And if housing was adequately supplied, those people would still benefit, right? Like property values go up over time, but they wouldn't see the massive increases and sort of the artificial wealth generation that they're getting. And I think that's a huge part of it. And a lot of us, I hold property and I technically benefit from this policy. I don't like it. I'd prefer that I didn't benefit from it because I think I could benefit more from a freer market. But technically, right, the increases in value I've seen in my properties are in some way tied to that, and so I think a lot of us are complicit, right? If you're an older Canadian and you're 70 years old, let's say, and you've had your home in Toronto for 40 years, right? You worked hard, you did your part, and now your home is spectacularly worth $1.5 million, and you get to live the good life at the end of your years. Like, how interested are you in making sure the government behaves in a fair way so that people can afford homes if it means that your house has to go back to being worth $750,000 and you don't get to live the high life, right? That's kind of what the equation is, right? And so politically, there's not a lot of democratic will to fix the situation because so many of the voter base are benefited by it, sort of, or at least that's how it appears to them. They don't realize that in a lot of ways they aren't, because it's the negative impacts on the economy mean that they're losing out, right? The fact that we have a generation of young people who are dedicating all of their energy towards trying to buy a home means that they aren't putting that energy towards other things, maybe building businesses, inventing things, making the world better and easier. And unfortunately, we have a whole group of people now who literally think communism or at least some extremely close to communism form of socialism, which, I mean, they're synonyms, so it's so weird how we use language, but right, thinks that that's a good idea. And that's, I mean, history shows us that is not in your average person's interest. And yet, our politics have done such a good job screwing up our economics to try to, advantaging certain people over other people, not necessarily meaning to, but just slowly doing it over time, that, I mean, that we literally are facing like record levels of communist thought, or whatever you want to call socialist thought, people thinking that capitalism, which is terrible marketing. Capitalism is a term that was coined by Marx, okay? You have to understand that, like, the way we use language is all messed up. Capitalism is not capitalism. Capitalism is freedom, okay? Now, America is not really a capitalist country because they have a lot of cronyism going on, and Canada as well, right? And to call these capitalist countries is not really true. They're cronyist states at this point. They were capitalist at one point, right? They were very free places. And when you have freedom, you're free to trade. And if you're protecting people's individual freedom and allowing them to trade freely, that is capitalism, but that's really just freedom. And it turns out that makes people happier and more productive and better than any other system has ever accomplished in the past. And yet people hate it. And people hate it for a variety of reasons, and they always have. And you've always had the people who seem to hate it the most are the elites. And the reason that the elites seem to hate it, in my estimation, is because, look, if you have a system, let's say monarchy and the sort of feudalistic system they have in England, you have a queen and her family, and they sit at the top of the hierarchy. And look, her son, now he gets to sit at the top of the hierarchy, right? She's dead. And then his spoiled ass kids are going to sit at the top of the hierarchy, and there's no merit there. These people are just there, and I mean, we've seen the royal family. I mean, they're a bit of a joke these days with the scandal and everything. I guess they probably always have been, but in my life experience, this is kind of the second time they've been riddled with scandal since I guess before mom was the scandalous one. Now it's one of her sons, but they sit at the top of the hierarchy, So in capitalism, you sit at the top of the hierarchy if you're the best. It's like playing basketball, right? LeBron James is the king. He's the great one, whatever the hell they be calling him, because he was the best during his time. And really now, probably people don't call him that anymore. He was that, but I don't know whether you want to give it to Steph Curry or Kevin Durant or somebody, but somebody, Kawhi Leonard, whomever, but somebody is the best in the league right now. Maybe Luka Doncic, I don't know. Somebody is the best in the league right now, and it's probably not him anymore. And that is the problem with freedom or capitalism, is the people at the top don't stay at the top. And once you get to the top, you want to change the rules to make sure you stay there, because the Queen's got a sweet ass deal, right? That's forgive my language. They've got a sweet deal. They want to stay at the top. So there has always been the elite get to the top, and then they want to change the rules so that they get to stay at the top. And so freedom has always had a built-in enemy. The people who succeed under freedom don't necessarily want to remain under freedom, right? And you see this. Look at, for example, we have Google. Google, fantastic company, did a lot for the world. I think they've done a lot of bad things. I think they've done a lot of good things. I think probably on balance more good than bad. Love their product, or a big fan of what they did. Certainly up until about, I don't know, 5-6 years ago. Not such a big fan more recently, but this is the thing. Things change over time. But what do we have on the horizon? ChatGPT came out last year. It's up to 100 million users already. Fastest information technology to ever reach 100 million user base. Faster than the internet, faster than social media, the fastest. Okay. And what does ChatGPT do? Well, you talk to it. You text with it, and it gives you answers to stuff. It basically replaces Google, right? Why do I need to go to Google to ask it a question where Google gives me all these like irrelevant answers that don't really answer my question? And I have to be very specific and kind of mechanical and robotic about what I type in the search bar to get the answer that I want, when I can go to ChatGPT and have a conversation with it like it's a person, and it talks back to me more or less like a person and gives me answers to exactly the question that I asked. So Google has a problem. There may not be a Google in 10 years because ChatGPT may eat their lunch, and that's capitalism. That's freedom. Some team of people were free to go make ChatGPT, and maybe that's going to screw Google. You think the Google people, all the way from top to bottom, like not just the owners, the Sergey Brins and the Larry Pages, well, they're the founders. I mean, the owners are shareholders now, but all those people, including all those shareholders, you think they want ChatGPT to come and destroy Google, this multi-billion-dollar behemoth, right? No, they don't. So they're going to do everything they can, and they probably already are, to get as much help from government regulation, blah, 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 to protect them from competition from ChatGPT. And we have that all throughout our society, distorting things, including in the real estate market. And so this is why it happens. I'm just kind of explaining it here. I'm going off on a tangent, but this is why it happens. And I don't see how you change it. I mean, obviously, if you educate people, maybe, but I don't think the problem is education. I think the problem is interest, right? There's incentives for people to do these things, right? Everybody who works at Google has an incentive to support laws that will keep Google in business, right? And they're more invested in the political process to make sure they keep their jobs and get those laws passed than all of the people who would benefit from Google going out of business, right? Like for me, the difference between Google and ChatGPT might be 25 cents a year, right? I don't know, something like that might be the difference in value between the two of them, right? But for a Google employee, it's their entire salary, right? Whatever that is called, $200,000 a year, right? So you can see, right? They have 800,000 reasons more than I do to care about a bill and the political. So they're always going to do their best to support it. They're going to get friends and family. They're going to rally people, and they're going to make it look like this is something the government needs to do. And me, I mean, I'm not getting out of bed for 25 cents, right? Right? Like how hard am I going to work to stop that, right? And certainly, especially when, for the most part, I don't understand, right? They always present these things as if they're here to help. Most regulation is bad, really. It doesn't help. It's usually there to keep the incumbent players incumbent. And you see this time and time again. If you look at any type of regulation and you look at the people who put it together, it's usually the incumbent businesses, right? And they've done market studies where after regulations are introduced, competition always goes down. There's always fewer players in the market, and the regulation always introduces barriers to entry for new competitors, which means that on top of being locked out of the housing market, those same young people are also locked out of building businesses because barriers have been erected that weren't there for the people before who created the initial businesses, for now younger people to come and iterate and make better businesses, right? And so that's also a problem. So these are all big problems with how the economy works. And so these all compound and they cause the inefficiencies, and then those eventually become the boom bust cycle, the ups and downs, and also the housing cycle. And right now, with banks positioned the way that they are, it looks like we're set to see another one of these go off. Obviously, if we continue to see banks being insolvent, right, then that is going to shatter market confidence, and at some point it will lead to unemployment, right? And then as it leads to unemployment, we may start to see people get margin called on their homes, and that would cause basically the housing market to reset, for lack of a better language. And that sounds very bad, very doom and gloom. It's a fantastic opportunity for anybody who's prepared to go out and buy those properties when they're on sale, right? Because this is about mindset. If you have that belief and that the understanding and the belief that those properties, when everybody else thinks that that's a toxic waste asset, you're out there saying, oh my God, give me more. I want as much of this as I can. Then when they come back around and realize, no, it's not toxic waste, it's still the same gold that it was before. Well, now you've got a basket full of it, right? But you have to have the mindsets to where when everybody else is zigging, you're ready to zag, right? And so that's very important. So what's one of the things we can do to prepare, right? Well, this is the second thing I want to talk about, of course, researching your market, understanding your market, right? So I just said that technically in a perfect economic scenario, prices are correlated to rents, right? Because we can always compare the cost of renting a property to buying a property. And if they're not close, then why am I paying the premium to own the property, right? That's the basic economic calculus, and it makes sense, right? If I'm going to pay $2,000 a month to rent a place, and it's going to cost me $3,000 a month to own a place, maybe I'll own the place, right? But if I can pay $2,000 a month to rent a place and it's going to cost me $6,000 a month to own a place, maybe I'd rather rent the place, right? And I showed you how, right, by doing that, you could have as much as $236,000 or more to invest, which in the stock market might net you almost $48,000 a year, and in real estate might net you closer to $70,000 a year and could allow you to snowball your investments, right? So doing that comparison should get us the approximate economic value of any property. So for example, at 3.5% interest rate, right, $100,000 to borrow $100,000 costs $500 a month. That's an idealized 25-year amortization, et cetera, et cetera. So we know, for example, $500,000 excuse me, $500,000 property at 3.5%, 25-year amortization costs $2,500 a month to hold a mortgage on. Or sorry, not a $500,000 property, a $500,000 mortgage, right? So if you take a property, $1 million, $200,000 down, that's an $800,000 mortgage. That's a $4,000 mortgage payment, right? So that property, in theory, we should be able to rent something somewhat similar to that property for about $4,000. That should be what it costs to rent that type of property. And if we go in the market, we will see that probably that type of property might rent for, I don't know, $3,000, maybe $3,500, but that'll be the upper. And so usually the basement won't be included, and you could theoretically rent out the basement for between $15,000 and $2,000 on top of that, and that gets you to, about $5,500, which does in fact make sense. That's comparable to the mortgage, right? And so that is the economic value of the home, right? That $5,500 can carry this amount of mortgage, right? And so that's how much you can pay for the property. So in a market, obviously prices are always fluctuating. We've had prices climb quite a bit as of late. So we need to identify our market. And this is why it's important to have a criteria, right? Is your criteria is obviously about type of property, maybe style, finish, blah, 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 those things, right? But it's also about location, right? And having a criteria for our location means that we can now study the rents in that market, right? Now, obviously, we can get broad market data. We can go to the CMHC and see things by metro area, maybe Mississauga, Brampton, GTA, Hamilton, KWC, whatever. Those are very broad numbers, right? Obviously, different neighborhoods are going to get different rental rates. So you should really drill down to the neighborhood level and understand, hey, how much are properties renting for in this area, right? And there's a variety of ways you can do that. There's services like Rentometer or Rentometer. I'm not sure how you're supposed to pronounce it, .com. Even Realtor.ca will give you like approximate market rents. Zillow, if you're in the States, will give you approximate market rents. And of course, if you're working with a realtor, you can ask them to pull up some comps for rents in the area from the last few months and see what things are renting for. And you can gather that data and you can get an idea of what the average rental price is in that area. And that gives you a very strong idea of what price is justified to pay for a property. If you're buying and holding, that really is what price you're willing to pay for the property, right? If that area is getting an average of $4,000 a month in rent, you really don't want to pay more than $1 million for a property, which would be an $800,000 mortgage, right? And ideally, you'd like to pay a little bit less than that because you don't really want to be at the max of that mortgage because you want to have some cash flow, right? You don't want to be breaking even. You want to be cash flowing, especially since you may have to, depending on the property, you may be paying for utilities and stuff, right? That may not be your only expense. You certainly got taxes and insurance to worry about in there, if nothing else. Right. And so we should be looking for properties that match our criteria in our area. So for example, if if I'm looking for a property in let's say Streetsville is a community here in Mississauga. If I'm looking for a property in the Streetsville area, right? Well, there are homes in Streetsville. There are detached homes in Streetsville. There are semi-detached. Yeah, there are semi-detached homes in Streetsville. There are bungalows in Streetsville. There are walk-up apartments in Streetsville. There are apartment buildings in Streetsville. There are that's probably it, I guess. Depending if you want to include I guess you would include that area. There are also some mansions, I guess you'd call them, kind of more McMansions, the more builder, not bespoke, but still very large homes. Let's put it that way. All in Streetsville area, right? Those very large homes, for example, are renting, and I'm sure some of them do rent, right? Executive rentals are renting for much, much more than say the walk-up apartments are, right? So it's not good enough to just take Streetsville and get our average rent there because it's being distorted by the different types of property. So we really want to drill down to what is our criteria for a property. Are we buying bungalows? Are we buying the walk-ups? Are we buying the apartment buildings? Are we buying the big McMansions? What are we buying? And then we want to get the rentals for those properties, right? So we can get an accurate comparison. And that is going to tell us, hey, look, these McMansions they're renting for $7,500 a month, right? And so now we know, $7,500 a month, we can carry a $1.5 million, $1.55 million mortgage, something like $1.6 million mortgage, something like that, right? And so that's okay. Well, that means maybe we pay about $2 million for those houses, right? And maybe on the bungalow, right, it's getting just $4,000 in rent, so we can only afford $1 million for it, right? But that's going to tell us approximately what the property is worth to us, and it's going to tell us what the property is worth to an investor. So now, if we're going to buy that property and we're going to hold it, this is the number we want to hit so that we can have cash flow. But if we're going to buy this property, maybe we're going to try and flip it, we're going to try and wholesale it, we're going to try and sell it to somebody who's going to look at it as an investment. Well, for them, they might be looking at the equity, right? That's part of the equation, but they're also, at least if they're real investors, they're going to be looking at the cash flow, right? And so that property is now going to be closer to cash flow because the price is in line with what the rental rates can bear, right? And investors, depending on their time horizon and how aggressive they are, right? There are plenty of people who may be investors who don't mind if it takes 2 or 3 years for that property, or maybe even 5 years for that property to start showing a return, right? Maybe it takes a year to stabilize and get a renter in and set everything up and blah, 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 right? Lots of investors are okay with that because to them, hey, look, I'm going to buy this property. 20 years from now, it's going to be worth more than I paid for it, and I will almost be paid off, and we'll be able to keep the rent, and I can afford it right now, so it's just fine, right? There's a lot of people with that mindset. Not everybody is looking to leverage investment growth in the real estate sector to grow their wealth, right? Only some people want to do that. So some people just want to kind of use it as a just kind of plain investment. And so they'd be happy to maybe pay $1 million for a property that is going to break even, which means it's going to lose money because you've got taxes and insurance and stuff for the first couple of years in anticipation of, rents climbing a little bit or their ability to improve the property and get a bit more rent or something along those lines, right? But only to a point, right? Nobody's paying $400,000 above what the economic value of that home is if they're a serious investor, because it doesn't make sense. There's no time horizon in which you can be sure you're going to recoup that money, right? But certainly, to have a property that's a little bit short of cash flowing is probably fine for a lot of people, right? And for a lot of investors. But you need to know this so that you can sell it, right? If for example, I'm going to buy a property and flip it, right? And let's just say I can buy this property for $600,000, right? I'm going to put $200,000 into it. And by the time I'm done, it will have gone from being worth $600,000 being worth $1 million, right? I'll spend $200,000, so I'll be in it for $800,000, right? And now I'll make a cool $200,000 profit, right? If I sell that property for $1 million, right? But to sell that property for $1 million, I need to know that after I've renovated it, I can rent it for $4,000 a month, so that it is justified to the investor who's buying it when I'm done, assuming I'm trying to sell to an investor. Obviously, I'm trying to sell to the market. That's, again, these two things should be related, so you're going to need to be close, but, individual home buyers will pay a premium for homes. That's just what they do. They won't always. At some points in the market cycle, they won't, but in most conditions, they seem to be willing to pay a bit of a premium for a home. And again, in the GTA, that will probably be the case for the far foreseeable future. But you've got to know your rent so that you can make this judgment, right? And then the more that you know what that market can bear, the easier it becomes to analyze, right? Because you have a baseline price. Hey, this is the price I need to hit for this type of property in this area. And now you can go from area to area, establishing what the market price is for your criteria property, finding those properties and identifying what the price is. And if you want, you could just take a scattershot approach where you just offer on all those properties. Hey, this is the price. I know at this price, we're good. I'm profitable. Here's an offer. Obviously, most people aren't going to accept it. That's the nature of making offers. Certainly, if you're trying to get the right price, right, you can get 100% of your offers accepted. Always. I can guarantee it to you. I've got a strategy. Just offer, 50 times what the property is worth. Almost everybody is going to say, I guess I should say almost, because there might be one or two fools who wouldn't. But in general, everybody's going to say yes to you because you're overvaluing their property, right? But if you want to get a property for what it's worth, that's a harder thing to do. A lot of people are going to say no. People will gladly say yes to having their property overvalued, but they're not so fond of having their property properly or undervalued, right? And so that's just this is the challenge that you deal with in making offers. But this really allows you to strategize, right? I want X for Y. And once you've established what Y is, in this case, your multiple on your rental rates, then you're good to go. Now, there is another factor here, right? Obviously, I'm comparing an idealized mortgage, right? So I said at 3.5% for 25 years, we're getting $500 per 100,000. You could obviously amortize for 30 years, in which case your payment would be a little bit less, right? And you could also have a higher or lower interest rate, right? And you could also put more or less than 20% down, which would also change the math. So those are all factors as well. But typically people are going to put 20% down. So when you try to put yourself in the shoes of the buyer, That's what they're typically going to want to do. They might put less in. That's their business at that point. That they're doing their own thing. But typically 20% is where you want to hit that down. As for interest rates, obviously we don't have 3.5% right now. We're quite a bit higher. And that just makes the math a little bit harsher, right? Obviously, it costs a bit more than $4,000 right now to carry an $800,000 mortgage. Quite a bit more. In fact, it probably costs you closer to $5,000 to carry that mortgage right now. And if interest rates go up further, it could cost you $1,500 or so to carry that mortgage, right? Up to say a $5,500 a month payment. So that's a factor as well. Obviously, like I said at the beginning of today's seminar, we've seen rental rates rise and prices fall. Like they're trying to get towards each other, right? So if you buy a property as an investor and you're getting that interest rate, you're going to try to get break even, which means you're going to want to pay even less, and that puts downward pressure on prices, right? So you want to factor that into your rental rate comparison as well, right? But understand, right? People will, again, there is some wiggle room in there, right? Like I don't want to make people feel like you're super rich. People will go a bit above or beyond, above or below sort of that break even point. Again, they ideally want profitability, but a lot of people might settle for break even, looking at a longer term, right? But you need that to really understand your pricing and what you can sell for, and what you can sell for in one condition, what you can sell for in finished condition, right? Because in some ways the market will lie to you. You can do property value comps, right? But those property value comps might be a lie because there may be other factors that are influencing why they got that price that don't remain as the interest rates change, right? There might be a desirability factor that really dies off once you pay too high of a price premium, whereas this sort of economic value analysis is always true as long as you are plugging in your current interest rate. You always know that this is a safe price to pay for the asset. And now you're treating it much more like a business transaction than like a purely real estate transaction. So that's a very good thing to do. And obviously, because things are fluctuating so much, you should definitely be at least checking in regularly with rental rates, maybe monthly, maybe quarterly, but just making sure that you're aware of what the current market rates are in the markets that you're analyzing and at the properties that you're looking at, so that you've got a baseline for what prices should be and where approximately you want to be to buy into that property and hold it, right? To buy into that property and burr it, to buy into that property and flip it, even to try to wholesale the property, right? Because ultimately for you, that stuff isn't going to matter as the wholesaler, but it will matter to your potential buyers, right? So they still need to know. You still need to know it so that you can qualify your buyers and find the right fit for your investment, right? So really, really know your market, right? I opened up with sort of the economic outlook and where I kind of feel we are in the housing market cycle. I think there's a fantastic opportunity coming for people to make a lot of money when the market corrects itself, right? But by knowing your market, then you can make smart investing decisions and buy at any point. See, this is the thing about the market, is timing is great, and there are certain times that are better than others to enter the market. But as long as you're analyzing and doing the right things and understanding your investment, holistically, the rental side of the equation, the ownership side of the equation, putting it all together, then you're going to be buying investments that make you money, right? That's the thing, is if you can rely on your math and understand, okay, this is where I get my money from in terms of the rental equation. This is what the market's willing to bear. This is definitely what I can sell or rent my product for, right? And on the other side, okay, and this is what it costs me to provide that product to them, and this cost is less than this income, then you've got a viable business, right? And you're locked in. And one thing I recommend to everybody, people variable mortgage, fixed mortgage, blah, blah, blah. What should I do? I never know. The market is crazy. And right now, of course, people with variable rate mortgages are saying, never again. I would never do a variable mortgage. You should always get a fixed mortgage because they're getting screwed right now, of course. Right. And then other people have fixed mortgages and they say, well, right now, I'm so glad I got that fixed mortgage. It was a great idea. Right. But of course, you get a fixed mortgage and be locked in at a high rate and rates go down and you'd be upset about it. And you'd have a variable rate in that situation. You'd be excited about it. And those exact same people would be saying the opposite of what they're saying, right? So what's the principle? What should one do? I personally would suggest usually get a fixed rate mortgage, even in a high interest rate environment like this. Why would I suggest that? Because if you get a fixed rate mortgage, then you know what your payments are for the next 5 years. So as long as you've done your analysis, right, and you've bought a property that cash flows, you know what your expenses are. They're fixed. You can increase your cash flow, right, you by increasing your rents and doing things on the income side of the equation, but you know that your expense side of the equation is locked, at least as far as the mortgage is concerned, for the next 5 years. And so that just allows you to make smarter economic decisions, I think. Are there situations where maybe I wouldn't follow that advice? Yeah, I mean, if rates have been at, I don't know, 14% for the last 3 years, and every indicator shows that they're about to start going down, I'd probably get a variable rate in that situation, right? I'd probably take my chances. But in general, right, if you have a fixed rate mortgage, then you know what your expenses are. And that to me is very valuable. Even if I could have made a little bit more money by not knowing what my expenses are going to be, knowing what my expenses are going to be allows me to make much more accurate predictions about the future and therefore to plan and strategize more effectively. So that's what people should be doing. And again, understanding the properties and getting ready to profit massively, because the opportunity is always there, but we're about to see a period of even greater opportunity, at least in terms of home prices, because what the market does and how difficult it makes things, that's going to be another side of the equation. But I don't look forward to it because I know that it's going to hurt a lot of people. Some people deserve it, quote unquote, in the sense of they made unwise choices and you reap what you sow. But whether that's the case or not, it's still not fun to see people hurting, and that is what happens. But unfortunately, that is what happens, and that is the detractors of capitalism, or as I called it before and will continue to call it freedom, will point out that there are winners and losers, and it hurts to be a loser. And yeah, that is the trouble with freedom, right? Is there are winners and losers. You got to make your choices, and if you made poor choices, you don't win. And I feel bad for those people, but at the same time, that's life, right? So there's an opportunity here. Excuse me, for those of us who are willing to reach out and grab it. And we should all be preparing, especially financially, to be ready to take advantage of the upcoming opportunity and preparing our knowledge base so that we can understand our markets and be ready to take massive action. And so, everybody should be working on that mindset so that, like I said, when everybody else starts zigging, you're ready to zag. And that's really going to propel you towards wealth very quickly, if you can do that successfully. And of course, that's a very, very, it's easy to say, it's a very hard thing to do, right? When everybody around you is panicking, it's hard to stay the course and remember that you've got the right idea and the right understanding and they're all fools, right? It's hard to do that, especially because sometimes people panicking will seem like they are smarter, more successful, further ahead than you are. And you still have to keep your head and say, no, I know better than they do. And, and that really comes down to understanding your market, understanding your product, understand the investment, the deal that you're making financially, right? So that you can have that unshakable confidence in it. And then move forward, taking action around those understandings. So thank you so much for your time. We will do this again next Sunday. And until then, if you have any questions or anything, feel free to email, text, whatever, reach out. And leave a comment if you're watching on YouTube. And can't wait to see you again next week. Thanks again, and have a fantastic day.